Hi, everybody. It's Peter Schiff here. It is Friday, March 4th, 2011. And today the government released the jobs report for February, and we created about 192,000 new jobs, according to the government. And the unemployment rate dropped again down to 8.9%. Now, I think the most interesting number that was released today relevant to employment was the labor force participation rate, which is the percentage of able-bodied people who are choosing to participate in the workforce. And that rate hit its lowest level since 1982. And so I think one of the reasons that the unemployment rate is only 8.9% is because a lot of the people are simply dropping out of the labor force entirely because they're so discouraged with the labor market that exists. And I think if you really want to put this number in perspective, back in 1982, you had a much smaller percentage of married women with children in the workforce. The trend of married women with children working, really started in the 1970s. But the double income household was still, I think, not necessarily the norm. I think most households, you still had the father in the workforce and had a stay-at-home mom. But during the decade of the 80s and then the 90s, more and more married women went into the workforce. I think the real reason for that has to do with the increase in the cost of government, the size and burden that the U.S. government was placing on the economy as taxes were rising. Fathers really couldn't afford to support families, and so their wives joined the workforce, many of them out of necessity. Certainly some women entered the labor force because there were great career opportunities, but certainly a large percentage of women entered the workforce simply because that was the only way to make ends meet. And so that happened. That trend continued throughout the 1980s. Today, the fact that we have the same labor force participation as we had in 1982, when many, many women were choosing not to be in the labor force because their husbands could afford to support them, that is a big deal. Because what's happening now, it's not that you have a bunch of women who are quitting their jobs and being staying-at-home moms because their husbands are now earning so much money that they don't have to work. No, what you're having now is a lot of people who are out of the labor force, not out of choice, but because of necessity, because they can't find a job, because they're so discouraged. And I've heard that a lot of the job losses that we're getting in this recession are hitting male workers harder than female workers. So this is particularly problematic. I bet a lot of the people who have left the labor force are men who want to work, who are able and willing to work, but have just given up trying, so they're no longer considered part of the labor force. And this is a big problem that is going to continue to worsen. Now, why is it that so many people are having such a hard time finding jobs that they're basically not even looking? It's because the government is destroying employment opportunities, employment incentives. It's all the regulations, it's all the taxes that are distorting the free market. We're vilifying and punishing employers, and we are erecting barriers that are preventing the economy from restructuring in a way that would produce employment opportunities for American people. And of course, I think the government is also making it more lucrative for people to remain unemployed than to accept, unfortunately, the lower paying jobs that are now being created as a result of government efforts that end up undermining the production of our economy and therefore the quality of the jobs that we are able to create. I thought what was very interesting today, I was watching an interview with Alan Greenspan on CNBC, and I thought it was really shocking some of the things that he was saying. First of all, he was asked if he thought QE2 was going to be a success, if it was the right policy. And you know what his answer was? His answer was, well, we don't know yet. We'll have to wait and see the results. That's it. I mean, it reminded me of Nancy Pelosi. We don't know if the policy is effective until we see if it works. I mean, if Alan Greenspan actually had some understanding of monetary policy, he would be able to know right now whether or not QE2 is the right thing to do. You don't simply say, well, I have no idea. Let's just see what happens. And if it works, then it was right. And if it doesn't, then it was wrong. I mean, you don't need any kind of intelligence to come up with that kind of insight. Also, he was asked, to compare Bernanke to Trichet. because over at the ECB this week he hinted that rate hikes are imminent, that the ECB is going to hike rates probably the next meeting. The ECB is worried about inflation, and of course Ben Bernanke continues to say that he's not worried, inflation is not a problem, and pedal to the metal on the printing presses. And he was asked, well, why are these two central bankers coming to different conclusions? And basically Ben Bernanke said, well, they're both basically the same school of thought, they're both looking at the same data, there's no real difference between them. It's just that they're betting on different things, they're playing different odds. That Trichet seems to think the odds favor that maybe there'll be some more inflation, and so he's going to tighten. But the way Bernanke looks at the numbers, he thinks the odds are that that's not going to happen. So in other words, according to Alan Greenspan, none of these guys has any idea what's going to happen, and they're all just a bunch of Las Vegas bookies trying to handicap whether or not there's going to be any inflation. And so Trichet, he's putting his chips on inflation, and Bernanke is saying, no, there's not. I'm betting the other way, as if there's no way to figure this out with any kind of actual scientific effort, that it's all just a game of chance, that we might as well be tossing coins. If that's the case, if it's all just guessing, why do we even need central bankers? Why don't we just replace Ben Bernanke with one of those chickens that plays tic-tac-toe in Chinatown? He could just as easily guess, which way inflation is going to go or whether QE2 is going to work. In fact, if we went with a chicken over Ben Bernanke, at least with a chicken, he'd have a 50-50 shot of being right. Bernanke is always wrong. Anyway, I also want to talk a little bit about an article I read the other day that talked about the total amount of government spending in the month of February. The federal government actually spent about $1 trillion last month. Now you might say, well, how could they have spent the whole trillion? Well, what happened is about $600 billion worth of debt matured, and so the government had to pay people back. So that's spending. Now, of course, where'd they get that money? Well, they turned around and they sold those bonds to new investors. Well, who are these new investors, first of all? Well, according to Bill Gross of PIMCO, about 70% of these bonds are being bought by the Federal Reserve, and maybe the other 30% are being bought by foreign central banks. But the reality is, private citizens, private investor demand is really drying up for treasuries. I mean, who would want treasuries? So what's happening is, as treasuries are maturing, those that are in the hands of private investors, they don't want to roll them over. They don't want to reinvest at these low rates. So they want their money back. And now where is the government getting the money? Well, they're getting it from Ben Bernanke. Now, what happens if Ben Bernanke actually does what he says? And QE2 ends, and they don't have QE3, and the Fed shrinks their balance sheet. What is going to happen? How is the government going to refinance all this maturing debt if nobody wants to roll it over? Well, only two things can happen. Either interest rates are going to have to rise dramatically so that we can find buyers for these bonds absent the Federal Reserve or foreign central banks, or the U.S. government is going to have to slash other spending or raise taxes so it can pay off maturing debt. You see, a lot of people want to focus on just one part of the national debt, and that's the interest payments, the annual interest payments that we have to pay. But what's more important than the interest payments is the principal, especially when you've been borrowing short, which is what the U.S. government has been doing. We've been selling a lot of 30-day bills or one-year bills. And as these bills mature, the owners don't have to roll them over. It's kind of like the difference between someone who has a 30-year mortgage where, you have 30 years to pay it off versus somebody who's maybe got a balloon payment every year, where every single year your mortgage matures and you got to go find somebody else to make the loan all over again. Well, what if you can't do that? Well, then you're out of the street, right? If you can't refinance. That's what we've done. And I think with these ridiculously low interest rates and all the inflation that the Fed is creating, look, silver hit a 31-year high today. Gold almost made a record high, just shy. Oil closed at $104 and I think 50 cents a barrel, up $2.5. That's a 2.5-year high. Commodity prices, CRB itself, hit a 2.5-year high. All this is coming because of inflation. It's not because of the Middle East or anything else. It's because central bankers like Ben Bernanke are printing too much money, and our creditors know this, and they don't want to keep rolling over this debt. So we have a real serious problem with the national debt, not just the interest, but the principal, because a lot of that principal is coming due. And believe me, as Bernie Madoff has said, we are running out of fools. Anyway, have a great weekend, everybody. I will be back again soon.